In 2001, WorldCom told investors it had earned nearly $2.4 billion before taxes. According to the CE, the company had actually lost about $662 million. That is not a small forecasting error, it is a different business. And WorldCom created that difference with a remarkably simple accounting move. By the time the full story emerged, WorldCom had made more than $9 billion. In false or unsupported accounting entries, the total restatement would grow. To roughly 11 billion, thousands of employees lost their jobs. Retirement savings were crushed, and the company filed what was then the largest bankruptcy in US history. But before WorldCom changed the books, it trained Wall Street. To expect growth that never stopped, the company began in 1983 as Long Distance Discount Services, or LDDS. It was a small Mississippi-based reseller of long-distance telephone capacity. It did not need to own every mile of cable. It could buy capacity from larger carriers and sell service to customers. Under CEO Bernard Ebbers, the company grew by acquiring other telecom businesses, often using its own stock as currency. A higher stock price made it easier to buy another company. The acquisition added revenue, which excited investors and supported the stock price needed for the next deal. Growth produced a currency for more growth. In 1995, LDDS became WorldCom. In 1998, it acquired MCI in a deal approaching $40 billion. The former discount reseller was now the second largest telecommunications provider in the United States. For years, acquisitions made reported revenue jump, and investors stopped seeing a phone company. They saw a growth company. The market rewarded each new deal, but acquisitions also made the company harder to understand. Revenue kept rising while different systems, businesses, and accounting records were being combined behind the scenes. That distinction became a trap once investors value a company for relentless growth. Slowing down does not feel normal. It feels like failure. WorldCom's acquisition strategy hit a wall in 2000. Antitrust objections stopped its proposed $115 billion merger with Sprint. The biggest acquisitions were over. Now WorldCom had to produce growth through actual operations. At exactly the wrong time, the telecom market turned downward. Competition was intense. Long-distance prices were under pressure. The industry had built more network capacity than demand could absorb. WorldCom's business was slowing. Its promises were not. One number was especially important: line costs. Line costs were fees WorldCom paid other telecom providers to carry calls and data across networks it did not own. Think of a delivery company paying tolls to use someone else's roads. Those tolls are a cost of making today's deliveries, so they belong on today's income statement. For WorldCom, line costs represented roughly half of total expenses. When those costs rose, profits fell. In 2001, the company began capitalizing those operating costs. Suppose a restaurant spends $10,000 on food this month. That food helped produce this month's meals, so the restaurant records the $10,000 as an expense now. But imagine the owner calls that food a long-term asset instead. Suddenly, much of the cost no longer reduces this month's profit. The restaurant appears more profitable, even though the cash is gone, and the food has already been served. WorldCom did a corporate version of that. Operating line costs that should have reduced profit immediately were shifted from the income statement to the balance sheet. Once labeled as capital expenditures, those costs could be recognized gradually, instead of all at once. For 2001, WorldCom reported approximately $14.7 billion in line costs and nearly $2.4 billion in pre-tax income. The CSIC alleged that its real line costs were approximately $17.8 billion, and that the company had suffered a pre-tax loss of about $662 million. One accounting classification had helped turn a loss into a profit. The entries were not subtle. Many were huge, round dollar amounts, recorded near the end of a quarter. From early 2001 through early 2002, WorldCom improperly capitalized about $3.5 billion of operating line costs. The numbers appeared to meet expectations, but the business underneath them had not improved at all. A fraud like this becomes harder to maintain every quarter. Old false numbers become the new starting point, forcing management to find even larger adjustments, just to make performance look stable. WorldCom's books began accumulating clues. Capital spending attributed to a vague corporate category appeared enormous. Accountants were asked to make entries without adequate support. Employees who questioned them feared challenging senior management could cost them their jobs. That is how corporate culture can protect bad numbers. It does not require everyone to believe them. It only requires people to believe that speaking is more dangerous than staying quiet. In May 2002, WorldCom's internal audit team accelerated a review of capital expenditures. The team was led by Cynthia Cooper, WorldCom's Vice President of Internal Audit. Cooper and her colleagues found a roughly $3 billion difference they could not reconcile. A mysterious label kept appearing: prepaid capacity. Chief Financial Officer Scott Sullivan asked Internal Audit to delay its review. The team continued. An internal audit manager named Gene Morse gained access to the company's journal entry system and found the entries. They were easy to spot because they were so large and so round. Billions were hidden behind accounting labels, executive authority, and the assumption that nobody with enough access would keep looking. Cooper's team did keep looking. That persistence matters. The fraud was not uncovered by a brilliant prediction from Wall Street. It was uncovered because employees inside the company refused to accept unsupported numbers as an answer. By June, the issue reached WorldCom's audit committee. Sullivan defended the accounting but could not provide adequate support. KPMG concluded that the operating costs could not properly be capitalized. Arthur Andersen withdrew its audit opinion on the 2001 financial statements. Sullivan was fired. Controller David Myers resigned. On June 25, 2002, WorldCom announced that it would restate its financial statements because $3.852 billion had been improperly transferred from line cost expenses to asset accounts. The number would grow as investigators went deeper. Less than 1 month later, WorldCom filed for Chapter 11 protection. With more than $100 billion in reported assets, it became the largest bankruptcy in American history at the time. The accounting trick preserved the appearance of profit. It could not preserve the company. Immediately after the initial disclosure, WorldCom said it would cut 17,000 jobs. Employees also watched company stock inside retirement plans lose most of its value. At the end of 2000, WorldCom stock represented about $642 million. By the time of a 2002 Congressional Research Service report, in employee retirement funds, that value had fallen below $19 million. The confidence came from the top. The consequences landed much lower. Bernard Ebbers was convicted of conspiracy, securities fraud, and making false regulatory filings. In July 2005, he was sentenced to 25 years in prison. Scott Sullivan pleaded guilty, cooperated with prosecutors, and received a 5-year sentence. WorldCom agreed to an CC settlement that funded $750 million in compensation for harmed investors. After restructuring, it emerged from bankruptcy as MCI. Verizon acquired it in 2006. The name disappeared. The lesson did not. WorldCom is remembered as an accounting scandal, but accounting was the final tool, not the original problem. The original problem was a business identity built around permanent growth. For years, rising stock funded acquisitions, and acquisitions created more reported growth. When that machine stopped, reality asked WorldCom a basic question. Can the business perform without buying the next chapter? The honest answer would have disappointed Wall Street. So the company produced a different answer. Moving expenses to the balance sheet did not create cash, improve the network, or attract customers. It only delayed the moment when the financial statements admitted what the business already knew. That delay protected the story for a little longer. It also made the eventual collapse far more destructive. For investors, WorldCom offers a practical warning. Be careful when a company consistently hits precise targets while its industry deteriorates. Be careful when growth depends heavily on acquisitions. And be careful when management treats reasonable questions as acts of disloyalty. Good accounting is not supposed to make a business look impressive. It is supposed to make the business visible. WorldCom collapsed when meeting expectations became more important than telling the truth.